Hello, everyone. John Brown and Guardian Rock Wealth. And I wanted to take a few minutes here to try and explain to you the why behind the what. So, a lot of people are feeling like, or actually seeing their investment portfolio that feels, or maybe actually is actually down, even though the headlines are saying the market's up, the market's up. And what they're usually referring to is those headline indices. So those S&P 500, the Dow Jones Industrial Average, maybe it's the Nasdaq or whatever it happens to be. Those indices are not neutral scorecards. They're constructed. They have rules. They have weights, and they're often not that apparent to somebody who's not involved with a day to day. Sometimes there's a very large handful, small number of companies, maybe large companies, that make an index look better or worse than the average portfolio might feel. Now, there's been a lot of talk about whether investors have been rotating out of the so-called Magnificent Seven. These are giant technology stocks that have dominated the major indices, and they've gone into other areas of the market. So I want to be careful here because we don't want to make up a story just because it sounds correct. What we can say factually is this: several credible observers have noted broader participation outside the mega cap tech names at different points during the year. Barron's recently noted strong breadth in the equal weight S&P 500, meaning the average stock outperformed the market cap weighted, which is the one that we see in the news every day, in that version of the index. Investing.com also reported that Deutsche Bank analyst saw a rotation out of technology, although they noted that the Magnificent Seven had still been largely holding up in the broader market. So the factual takeaway is that not everyone has abandoned tech. The better way is this: leadership has been uneven. Some money has been looking outside the biggest tech names, but the biggest tech names still matter enormously because they dominate the index math. And that means two investors can both say, I own the market, and still have very different results depending on what they actually own. And if your portfolio owns a lot of names that were strong earlier in the year but have cooled off, your personal results may look a lot weaker than the morning headline. If your portfolio owns sectors that are out of favor, the index can be green while your account feels a little flat. And if your portfolio is concentrated in just a few names, your results may have very little to do with the S&P 500 at all. And that's why it's important to manage portfolios not by the headlines, but manage them based on your purpose, your time frame, your risk management comfort level, the tax impact, your income need, and size your positions accordingly. So, a lot of things that are happening out there in the market this summer and fall are strictly mathematically, mechanically based. For instance, Verizon was pushed out of the Dow Jones Industrial Average recently, and Google was placed in there. Well, that caused some forced buying of Google for those who were forced to buy the index because that's the rules of their fund or whatever reason it might be. And it made some forced selling of Verizon, which frankly has not been a great performer for quite some time. And that impacted the overall market. When you have to buy something, then obviously something else has to be sold, right? If you have the same amount of money to start. Another thing that we have seen is the SpaceX situation where complete index rules were just thrown out the window. And now the Nasdaq, the Russell 2000, and a few other indices have said, we're going to allow SpaceX to be part of our index much earlier than we've ever let any other company do so. So that is happening throughout the summer of 2026. And then and that'll be forced buying of SpaceX. So whether you want SpaceX or not, whatever you think of it, if you own those indices, which you probably do in your 401k or your IRA or somewhere, it's the Nasdaq, some of the Russell indexes, and all that. You're going to be forced to buy SpaceX. And when you're forced to buy something, something else has to be sold, even if it's a very good company that you'd like to own. And so the market reacts in ways that you might not expect if you don't understand this. Then after that, we have several different months throughout the year where we're likely to get some more selling of the company SpaceX, simply because people who have been waiting for years to actually monetize their positions have the ability to do so. Nothing wrong with it. They've waited a long time. Maybe they want to buy that yacht or whatever it is that they would like to do, or maybe they just want to diversify a little bit and diversify their risk, which is just prudent wealth management. But when that happens, certain things are forced to be sold, certain things are forced to be bought. It doesn't necessarily have anything to do with fundamental what's a good company, what's not a good company. And this is why you have to focus on the longer term, and you have to have a system that works every time, no matter what the market is doing, because these index rules can push prices around in ways that have very little to do with whether or not they send rockets into space, whether or not they even make a profit or not. Satellites, revenues, long-term business value have nothing to do with that. It's just all about index mechanics and the mechanics of the overall market. So again, market mechanics after August 2026 could put pressure on SpaceX. Not necessarily the company, though. The company could be doing very well, and still the stock price could go down. It's not that SpaceX is a bad company. It means the stock is affected by the mechanics, the index buying, the float size, the lockups, the unlocks, the forced flows. And then you also have things happening, just as an example in strategy. And again, this is not investment advice. This is just explaining to you what things are going on. You have MicroStrategy just filing an 8K, which is a report that basically says, hey, something at the company is changing. We feel like investors should know. The SEC is going to want us to tell investors that this is going on. And a lot of people read these and they take them as, oh, this is going to happen or not going to happen. But the reality of it is that it was just an authorization to do certain things, like the authorization to sell up to 1.25 billion of Bitcoin to fund cash reserves, preferred stock dividends, and security buybacks. There were also buyback authorizations issued for 1 billion to buy back shares of strategy. Doesn't mean that they will, that just means that they can. And then they have another $1 billion that could be issued for dividend increase for preferred stocks. And that would actually be really good for the preferred stocks. And what it means is that those preferred stocks that are out there that attach to strategy, not all of them, but one of them in particular, has quite a bit lower risk profile now than it did just a day ago. And again, just market mechanics, not necessarily whether or not you think strategy is a good company to buy or a good business model. And some investors are going to interpret it negatively because they hear the words sell Bitcoin. They assume the company's original strategy has changed. But our view is a little more balanced here at Guardian Rock Wealth. We think this introduces optionality, and optionality is a very powerful tool in the right hands. And it can be a powerful tool in your portfolio as well, and in your wealth management system, which includes a lot more than just your portfolio if you're doing it right. If you know how to create optionality and you know how to utilize it, optionality does not create or remove risk. It is how you utilize it that makes all the difference. And optionality is almost always healthy. But again, you can use it in a way that is not healthy, almost like any good tool. You can use it wrong and it doesn't work. In the hands of somebody who knows how to use it, it can be a wonderful thing for your wealth management system, not necessarily talking about portfolios here, but it could be maybe as a tax management tool, could be as a debt management tool, such as what kind of mortgage you have. Do you have the traditional mortgage that everybody talks about, or do you have an all-in-one mortgage where you pay your principal first? Things like that. And of course, here on our YouTube channel, we have talked about all of that at one point or another, but always feel free to reach out to us at guardianrockwealth.com if you do have questions about how to create optionality for yourself. And also portion control. Again, if you own the right thing, but in the wrong size, it can still hurt you. If you own a great company, but need the money at the wrong time because of market mechanics, that volatility can destroy your entire portfolio. And if you chase that forced buying without understanding that there's forced selling later on, you're not really an investor. You're standing in front of the market plumbing and hoping that the flows come towards you. And that's not really working the system. That's not really a plan. That's just standing there hoping you're right. And trust me, over my career, a lot of times I've thought for sure I was right and I've been wrong. So having a portfolio and a wealth management system that works in any market scenario is what you want to have. And again, John Browning, Guardian Rock Wealth, we want to be here to educate you and help you in any way that we can. We're not here to sell you any particular product or thing. And this is not investment advice. I can only give investment advice if I talk to you and I understand your personal situation, because it's always different than the person sitting next to you. So if you're talking to somebody at the water cooler and they're saying, hey, I made so much money at SpaceX, that does not mean that it's great for you to go out and buy SpaceX. That person does not understand all the details of your personal situation, your tax liability, your risk parameters, or anything else. So just be careful about that. Or frankly, listening and taking advice from anyone on YouTube, talk to them in person first. Make sure they're qualified, licensed, and that they understand your personal situation. Again, it's John Browning from Guardian Rock Wealth. Hope you enjoyed today and hope you learned something. Reach out to us at guardianrockwealth.com, where you can take your phone, open up the texting app, text the word LIFE, LIFE, to 321-421-5213. Everybody have a great day out there. We'll talk to you again soon.